What's up, everyone? It's Karthik with MoneyVest. So, Federal Reserve Chairman Jerome Powell coming in hot and heavy with the big jumbo cut of 50 basis points. I do want to apologize first. I am sorry for the technical issues that we faced during the live stream. I fixed it and I came back online, and we had a very smooth live stream to finish off Jerome Powell's speech. So my bad, my laptop just really couldn't handle all the different tabs and the volume that we were dealing with, because we did have almost 3,000 viewers live at one point. So thank you so much for being there. I do apologize, and in the future I will make sure to not have so many tabs open at the same time, and my laptop is pretty much updated. Anyway, so I'm going to break down exactly what Jerome Powell said during his speech today. There's been some discrepancies with what the market's been pricing in versus how the Federal Reserve essentially been kind of guiding us in their summary of economic projections. And I've got something crazy right now. The news is that we are now actually pricing in for a rate hike from the market in November. The markets have a 67% probability for rates to increase by 25 basis points. I don't know what those Fed Fund futures are going to look like come November, but right now, as it stands, the markets are pricing in for a rate hike of 25 basis points, because the interest rates were lowered down to this number right here, 4 3/4 to as much as 5%. So if you come over to the Federal Reserve website, so you can actually go over and see that yourself. You can come over to the federalreserve.gov meeting and calendars, and you will see all the way down here, September 17th and 18th. You can pretty much open up this PDF, and you'll see that the Federal Reserve decided to cut interest rates by 0.5 percentage points to bring them down to 4.75 and 5%. So where we are right now is right about here. And the markets in November are expecting for a 25 basis point rate hike. And that is weird. So anyway, going over to my notes from Jerome Powell. And in my opinion, I think the Federal Reserve has lost control a little bit, because they're the ones kind of playing into the narrative as opposed to setting the tone or setting the narrative themselves. Because just because the markets are expecting the Federal Reserve to cut 50 basis points, what did the Federal Reserve do? They delivered on those 50 basis points, which was in the short term a little bit of a bullish catalyst. But what's also interesting is that we are now once again in a little bit of a discrepancy, because going into this meeting, the markets were pricing in for 5 rate cuts in 2024. The Federal Reserve had told us 1. So before we saw the rate cuts from today, this number was kind of like this, 5 and 1. Because the markets were pricing in for 5 rate cuts, 50 today, 25 in November, and then another 50 in December. The Federal Reserve had only really told us for 1 25 basis point cut. Well, after September 18th, which is today, we got the 50, which the markets were expecting. Now, the Federal Reserve is guiding for 2 more rate cuts. And the markets are, or at least were, expecting for 3 rate cuts in 2024. So 3 more in 2024 versus what the Federal Reserve told us was only 2. So I mentioned this in our previous updates in our live stream as well, that while the 50 could be bullish on a short-term basis, where 50 basis points is a jumbo cut, that's exactly what the markets were pricing in. However, the 2024 in the summary of economic projections, even if you are seeing that rate getting revised down, because that's exactly what we saw at the end of the day. So if you come over to the projection materials, you'll notice that the federal funds rate over here for 2024 was revised down from 5.1 down to 4.4%. So yes, the Federal Reserve is indicating more rate cuts, but that is still not as much as what the market was pricing in. So how is the market going to read into that revision, right? Because it is a downward revision at the end of the day. It's still indicating more rate cuts, but it's just not enough as what the markets were pricing in. And on top of that, you get a very mixed sort of Jerome Powell speech, where he's trying his best to put on a brave face and let the markets and the economy know that we are very strong right now. Definitely is, in my opinion at least, sending a little bit of a mixed signal to the market, which I'll go over during his speech breakdown in just a minute. So 4.4% that's where we are. So markets are still pricing in for 3 cuts. The Federal Reserve's told us 2. However, in 2025, we seem to be pretty aligned now at the same time, because 2025 markets expectations are for 3.25 to 3.5%. That has been revised up a little bit after the numbers that came out from today in the SEP in the statement, and the Federal Reserve's also pricing in for 3.4, which is somewhere between 3.25 and 3.5%. So that means 4 additional cuts in 2025. And from a market perspective, that's only 3 additional rate cuts. That's actually been revised up, because otherwise it would have been pretty normal at 4 and 4. In other words, where we would be. But right now, since it's been revised up, we are at 3 more additional rate cuts according to the market, whereas the Federal Reserve is pretty much selling us 4. So 2025 may come off as the Federal Reserve being more optimistic for rate cuts versus the market. But 2024 is really where the pain is and where the pain lives, basically, because not only are we signaling the market 50 basis point suggesting for some economic weakness, but we're also coming in lower compared to the market in terms of those rate cuts. And that's where the markets are in this dilemma of what is actually going to happen. I mean, QQQs pretty much had a lower high and lower low pattern. We saw a lot of volatility today, down about 43 basis points, and S&P 500 also down about 30 basis points, although after hours pushing back up over 17 basis points here, and volatility was also a lot of back and forth here. Still managed to close up 3.5%, and gold hitting a new all-time high at just over $2,600, with the dollar index selling off initially and then pushing back up, and the yields pushing back up to 3.7%. And this was another area of the market which I had discussed in my previous updates, where it's already priced in, folks. If you're expecting to bet on TLT or TMF that rate cuts is going to benefit those bond ETFs, it's already baked into the prices, because the treasury market, the bond market, has already been front running the Fed for a very long time, because we've talked about these charts before where the treasury yields have been dropping further. The yield curve uninversion has already taken place way before the Federal Reserve even came out with those rate cuts today. So that as a result, of course, TMF was one of the underperformers selling off here. So it was kind of like a sell the news type event for TMF, down about 3.5%, and TLT also dropping back down to under $100, down a little bit over 1.2%. Now, coming over to exactly what Jerome Powell said. He started with saying that at the FOMC meeting, we concluded that this was the right thing to do, which is the 50 basis point rate cut. It was a good place to start, for us in this quantitative easing cycle, and we will be making our decisions meeting by meeting. We will continue to be very data driven in our approach. We are now moving towards a more appropriate level or more normalized level of interest rates. We are not in a rush. We can go quicker, slower, or pause depending on what we see in the economy. And we know it is time to recalibrate. That was a word that Jerome Powell used many times during his speech. We know that it's time to recalibrate our policy given the progress made on inflation. The balance of risks are now even between the upside risk on inflation versus the downside risk on the economy. Now, this is where I do disagree a little bit. I think the upside risk on inflation still remains elevated. In other words, there's still a risk that inflation starts to accelerate back higher if interest rates continue to get cut in 2024. Because what does that mean? That means more spending, more borrowing, more investing, more buying, more consumption once again, because money is going to once again be very, very cheap. So if inflation starts to reaccelerate back higher, that perhaps is the biggest risk to cutting at such big amounts, right? 50 basis points. And the downside risk of the economy also is starting to move up a little bit because the labor market has been softening, which we will discuss in just a minute. And he also mentioned that during the meetings in the last couple of days, there was broad support for the decision that the committee voted on today. And most of the FOMC members voted on for more rate cuts, as you can see from the dot plot. And we will take it meeting by meeting. We made a good, strong, confident start to this quantitative easing cycle. We are confident that inflation is moving sustainably down to our 2% target. The labor market is in a solid condition. The U.S. economy is in a good condition. We want to keep it there, and we don't think that we are behind the curve. We believe that this is timely, and we have been very patient. We have waited, and that patience has given us the time to wait and see where inflation goes. In our base case, you will see the cuts moving along In other words, moving forward, we're going to continue to see more cuts coming in, and we are moving more to a neutral level. Economy could develop over time, and what may warrant an appropriate policy decision to move again, quickly, slowly, or pausing us. And we are now not thinking about stopping runoff. We can continue to shrink the size of our balance sheet while taking liquidity out of the balance sheet while also cutting rates at the same time. And labor market conditions have cooled off by any measure. We are close to the mandate, the dual mandate that we have set forth, and we need to recalibrate the monetary policy back to normalized level. Economy is still growing again. A lot of times he mentioned that, and we are not seeing rising claims. We're not seeing layoffs. The time to support the labor market is when it's strong, and policy is still restrictive right now, so we need to make sure that we focus on both parts of our dual mandate. And towards the end, he kind of slipped up a little bit. He said that it's time to change our stance, and so we did that. We made a good, strong start to changing our policy. It should send a strong signal that we are committed to achieving a good outcome. It wasn't committed to achieving inflation down to 2%. It wasn't committed to achieving soft landing, achieving a good outcome. That's what he said. And we don't see anything in the economy right now that a likelihood of a recession, a downturn is elevated. That's what he mentioned during his press conference. And talking a little bit about the labor market, he said that the job creation has depended very much on the supply, which has been increasing a little bit here. And we're not declaring victory on mission accomplished on inflation just yet. We want inflation to move sustainably towards 2%, so they're not declaring any victory yet they're cutting interest rates. And housing inflation is dragging on all inflation right now. It's been slower than we expected, and we want to restore inflation, and we don't want people to think about inflation anymore. And then also talking about unemployment of 4.2%, higher than the mid threes. That's where we were. That's still a very healthy labor market. Participation is at a high level. Wages are increasing, just still above the sustainable levels. And then vacancies have come down close to 1 because that job openings, I should say, versus unemployed persons, that ratio has come down to low ones again. We've talked about that on the channel before. And again, this labor market continues to be very strong, and the upside risk to inflation have come down, and the downside risk for the economy have increased as well. So there was a lot of times in that press conference, in that speech, that, in my opinion, he continued to kind of put on a brave face, talking about how everything is fine, economy is good, labor market's tight, there's nothing to worry about. But there's a lot of reasons why they would do a 50 versus a 25, right? There was no sense of, in other words, there was definitely a sense of economic weakness is one of the reasons, or perhaps the only reason, why they would do a 50 versus a 25, because inflation is not towards their target right now. Inflation is nowhere near close to their target, right? It's still above 2.5, 2.6, 2.7%. So it's not close to the Fed's target. They did not talk about that we are committed to achieving 2% inflation. They said a good outcome. That's what we're committed to achieving. And a 50 basis points cut, they mentioned again, is to avoid any type of economic downturn. So they really want to get ahead of that curve of a recession or economic downturn. And they also mentioned that, again, they don't see a likelihood of that happening. However, there's a lot of other indicators and signals that are suggesting for an impending recession. Again, I'm not calling for one, but the bigger risk, in my opinion, for the Fed and for the economy is a reacceleration on inflation, because that's exactly what happened in the 1970s and 80s when interest rate got cut very aggressively. What happened with inflation is, as we already know, it not only went higher, it went at a much greater level than where it did the last time. So imagine if inflation were to be over 10 or 12% a year from now, if interest rates continue to get cut very aggressively. We will literally be in the same situation. It'll be 2022 all over again, if not worse. So those are some things to keep in mind. While this is a good cut, while the markets are kind of reading a little bit more optimistically into this Federal Reserve meeting, it is still begging the big question here: is this going to lead to a recession in the future? Are we going to see a rising unemployment, economic contraction, earnings weakness in the future? If the answer is yes, I think this short-term bullishness is going to very quickly fade into some very brutal selling pressure. Or if the answer is no, then if the Fed can really engineer a soft landing, then we are in for some very strong rallies to the upside. So it's really unemployment and recession that holds the key to almost all the answers that the markets are looking for. And I think it's really going to come with time. But at 50 basis points, I was a little bit expecting 25 because I think that would have been a better start for the Federal Reserve, and the markets may not have had too much to think about whether that 50 means, coming back down to a more normalized policy stance, or whether that means economic downturn, because it really does leave the markets to make its own interpretation with that 50 basis point cut, as opposed to 25. I think 25 would have been less to worry about, is what I mean by doing a 25. 50 just opens the door to a lot of questions, right? That's what that does. Anyway, so going back over to the markets here. So, volatility back over 18.2. We did have crude oil back under $70. And if you take a look at the sector breakdown for where liquidity really went to, it was nowhere. I think all sectors were pretty much selling off on the back of this jumbo cut here. Energy only because oil prices were higher, but everything else was down, especially technology down almost 1%, although after hours were slightly up 20 basis points. The bond market down over 1.2. XLU was down over 76 basis points. We got materials, staples, financials, real estate, discretionary, pretty much all sectors across the board. S&P 500, of course, snapping its 7-day win streak right now as well. So the next meeting is going to be in November, on my birthday, November 7th, and the market's right now pricing in for a rate hike. Maybe they're expecting inflation to give us some upside surprises, but we'll see how these numbers change over time. And right now the market's still pricing in for 3 cuts or another, 75 basis points worth of cuts here, bringing them, well, actually now we have changed a little bit, I should say. So markets are now only pricing in for one rate cut. So I need to update those numbers, and I'll do that on my spreadsheet, but this is right now is what the markets are pricing in at the moment, 4.5 to 4.75%. And now the markets are only pricing in for one more rate cut, and the Federal Reserve's pretty much told us to. So that's where we are with those expectations for 2024. Now, coming back over to the market. So this right here is our chart that we've been keeping track of. So on the 30-minute time frame, you'll notice that once again we're back below certain levels, and we hit that resistance yesterday, new all-time high, and then rolling right back down. So next support really is going to be down in the 5581 to 5600. We'll continue to monitor how S&P 500 trades here. That it's coming back up to its resistance at 5630, 5640. It's not able to successfully break out above those levels, and that next support really is going to be down at 5580 to as much as 5600 for S&P 500. QQQs, on the other hand, also getting rejected once again. This right here has been a very, very strong area of supply for the NASDAQ, and we're not able to break out above this level, and next support is going to be down at 468 for QQQs as well. So a lot of consolidation sideways, and next support is going to be down as much as 468, 469 for the NASDAQ. Coming over to Apple stock here, Apple also struggling a little bit intraday, but still very strong. It was perhaps the only company that investors kind of flock towards is Apple, once again, kind of like a safety haven, and investors dealing with that uncertainty. This is where they find safety, pushing up over 1.8%, back over 220. And this right here, very, very strong area of demand for Apple, and resistance all the way up to as much as $236 for Apple as well. Support level is going to stay put down to 207, down to as low as 196 for Apple as well. Amazon, on the other hand, consolidating sideways, resistance all the way up to $190. Support level down to as much as 181. Really, it's been consolidating sideways for the past few days, and we've seen a lot of indecision on Amazon as well. Tesla, on the other hand, also consolidating sideways. I've got a covered call expiring in November for Tesla. I think it's finding it very difficult to break out of these resistance levels. We've got a lot of supply sitting in the 240s for Tesla, so that's going to be that resistance. Support level is going to stay put down as low as $225 for Tesla at the moment, and this right here is the higher highs and the higher lows for Tesla as well. I'm going to update our spreadsheets, and I will do another update tomorrow and go over where markets expectations are now. What is the Federal Reserve telling us? Because as we already know, the Fed is pricing in for 2 more rate cuts in 2024, and then 4 additional rate cuts in 2025 as per the summary of economic projections, because right now we're at 4.75 and pretty much 5%. And so 4.4% brings us down to 2 more rate cuts, or 50 basis points lower, and then another 100 basis points. In other words, 4 cuts also priced in for 2025. So the Federal Reserve pricing in for 2 in 2024, 4 in 2025, 6 total in the next year and a half. But the market's a little bit back and forth here because of this fresh news, and they still need to adjust with the Fed funds futures, because originally we were pricing in for 3 additional cuts. Now we're back down to only 1 cut, with a potential rate hike that could come in as early as November. So that's what the markets are pretty crazy about right now. So Tesla support level is going to sit at 225, resistance all the way up to $240. Nvidia also sold off quite aggressively towards the end of the day, down almost 2%. The likelihood of Nvidia trading below 111 is increasing, which is actually good news for me and my shares. And resistance is going to stay put at 118 for Nvidia. Support level all the way down to $96 per share. It's really struggling to close above 118 here. It's not able to successfully break out above this level. Even the high for today was 117.70 for Nvidia as well. Talking about advanced micro devices, and AMD also starting to rotate back lower. Support level is going to stay put down to 142 for advanced micro devices, and resistance all the way up to 162 for advanced micro devices as well. Talking a little bit about Meta platforms, and perhaps PayPal was the big outperformer on the day. We'll talk about that in just a minute, but Meta here also pushing up over 30 basis points, almost up to as much as a new all-time high here, and we're coming up to a huge area of supply. Support level down to 480, down to 458 for Meta. Talking about Netflix here, and Netflix also was hitting close to a new all-time high yesterday. And then it's now starting to roll over, down 2.3%. Support level is going to stay put at 662 for Netflix, with a resistance now sitting put roughly at $700 per share. Google, on the other hand, consolidating sideways, so not a lot of movement here on the day. So a little bit of a doji candle coming up to its area of supply in the 164 to as much as 169 for Google, and support level is going to stay put at 153. Nice little bounce back higher from that area of demand that we identified for Google. Microsoft also rolling over, 2 back-to-back red candles here, breaking down below that support. Next target and that area of demand sits at $400, so low 400s, as much as sub 400s, going to be that level to watch for Microsoft. And coming over to some big outperformers here, PayPal up over 1.8, almost 2% at one point, coming back up to its resistance at $73-74. So this right here, very, very important level of resistance to keep in mind. And support level, of course, sitting roughly inside this green rectangle at 68 to as much as $70 per share for PayPal, all the way up to as much as $76-77 for PayPal as well. Visa, on the other hand, starting to roll over. As discussed, it was very overbought, so not a huge surprise. Support level is going to stay put down to 282, 283, and resistance stays put at $290 for Visa. So the bottom line is, I am not super confident about whether this 50 basis point rate cut is going to result in a lot of bullish sentiment. It could in the short term, but the real question, once again, and will continue to be, what is going to be the state of the economy 3, 6, 12 months from now? And if we are in a mild or a severe correction for the economy, contraction or earnings drop, that's really what's going to dictate how the markets trade moving forward, as we have discussed in our previous updates, where if there is a recession, the markets take a whole different trajectory versus if there is not a recession. So 50 basis point cut, the Federal Reserve had to put on a brave face, because they're never going to come out and say that, look, we're expecting economic weakness, or we're expecting a downturn, we're expecting unemployment to go up. That's why we're trying to support the economy before it gets worse by cutting rates by 50 basis points. They'll never say that. They'll never say those things, right? So it's up to us to try to read between the lines and really try to understand, okay, what is really the reason the Federal Reserve is cutting interest rates here? And in my opinion, I hope I'm wrong, but in my opinion, it is more about the Federal Reserve kind of witnessing some weaknesses themselves, as opposed to normalizing policy, because they could have very well started at 25. Cutting as much as 50, that's how I'm reading into it. Let me know your thoughts down in the comment section below, and what do you think about the 50 basis point cut? And also, the market's now expecting for a potential rate hike of 25 basis points. That's kind of wild. But let me know in the comment section below. As always, make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you're interested in joining us. Happy investing. I'll see you all in the next video.